34% down, 5 months to recover, 190% up in the 6 years after. Those two numbers came from the same event, March 2020. The S&P 500 dropped from 3,386 to 2,237 in 33 days. And then it more than tripled. By March of this year, the index sat above 6,500. By this week, it crossed 7,000. But not everyone was there for the ride. The people who sold at the bottom, and there were millions of them, did not just lose 34%. They lost the 190% that came after, and the compound growth on that 190%, and the compound growth on the compound growth. That is not the same number. That is not even close to the same number. Think of panic selling like pulling a plant out of the ground to check if the roots are okay. You did not just pause the growth. You killed the timeline. The soil resets. The seasons start over, but your age does not. There is a person in Indianapolis, 29, working in claims adjustment, making about $63,000 a year. In February 2020, they had $41,000 in a target date fund inside a Roth IRA. They had been contributing since they were 23, automatic deposits. $500 a month, never missed one. The 16th of March 2020, the account showed 29,000, down 12,000 in 3 weeks. They logged in, saw the number, and moved everything to a money market fund. Cash, safe, done. They told themselves they would move it back when things calmed down. Things calmed down fast. The market bottomed 7 days later. But calm down did not feel calm. The headlines were still about ventilators and shutdowns and unemployment claims, hitting 6 million in a single week. So they waited. They waited through April through May. They moved the money back into the target date fund on the 15th of June, 2020. The S&P had already recovered to 3,124. They missed the sharpest bounce in modern market history. They lost 85 days. That is all. Here is what 85 days cost. Start with 41,000. If they had done nothing, absolutely nothing. That account, with continued $500 monthly contributions and the market's actual returns, would sit at roughly 131,000 today. 6 years of compounding on a base that was never interrupted. The math is clean. Instead, they sold at 29,000, sat in cash for 85 days, earning almost nothing, bought back in at a higher price. Their base was smaller. The compounding curve restarted from a lower floor with a shorter runway. That account today is closer to 97,000. The difference is $34,000. Not because they panicked forever, because they panicked for 85 days. That is not a rounding error. That is a car, a year of rent, 18 months of groceries. The number does not negotiate. Now, here is the part most people skip. The cost is not just the gap between 29,000 and 41,000. It is not even the gap between 97 and 131. The real cost is the gap between 131,000 compounding for the next 25 years and 97,000 compounding for the next 25 years at 7% average annual return. That $34,000 gap today becomes a gap of over $185,000. By the time this person is 54, 85 days, $185,000. And the claims adjuster in Indianapolis did not do anything unusual. They did exactly what most people do. They looked at the number, felt their chest tighten, and clicked the button. That decision made perfect sense in the moment. Every financial instinct they had said, get out. The mistake was not irrational. It was the most rational feeling decision they had ever made. The cost was $185,000. By any honest measure, this person did everything right for 6 years. The system punished 85 days of fear more than it rewarded 72 months of discipline. I need to stop here and say this clearly. Everything I just walked through uses publicly available S&P 500 index data, hypothetical portfolio math, and general compounding principles. This is not personal advice for anyone's specific situation. Your numbers, your timeline, your risk tolerance are yours alone. A licensed financial professional who knows your full picture is the only person qualified to tell you what to do with your money. But the pattern in the data is very hard to argue with because this was not a one-time event. April 2025, the tariff announcement. The S&P 500 dropped roughly 12% from the 2nd of April to the 8th of April. Over $5 trillion of market value erased in 48 hours on the 3rd of April and 4th alone. According to Reuters, the worst two-day stretch for the index since March 2020. And what happened next? Same thing that always happens. The index turned positive for the year by May 13th, according to data from the Wall Street Journal. By the 27th of June, the S&P closed at 6,173, a new all-time high. By the 31st of December, the S&P 500 finished the year up 16.4% on price, roughly 17.9% total return, including dividends, per S&P Dow Jones indices. The people who held did fine. The people who sold in the first week of April and waited until June to come back left money on the table. Again, the exact same pattern, the exact same mistake. The exact same cost, not the dip itself, but the recovery they were not present for. And now this month, we are watching familiar headlines. Again, pharma tariffs, new duties on branded drugs, markets dipped, headlines got loud, and somewhere right now, somebody is hovering over that same button. But here is the part that should stop you cold. JP Morgan Asset Management tracked what happens to a $10,000 investment in the S&P 500 over 20 years from January 2005 through December 2024. If you stayed invested the entire time, that $10,000 became $71,750, a 10.4% annualized return, according to their Guide to the Markets report. If you missed the 10 best days, just 10 days out of roughly 5,000 trading days, your balance dropped to 32,871, cut in half, not by a downturn, by absence. If you missed the 20 best days, you were down to 19,861, below the S&P's long-run average, from 10,000 to under 20, in a market that did 7x over the same window. Miss the 60 best days, 4,712. You lost money over 20 years in one of the greatest bull runs in history because you were not in your seat on 60 specific days. And the number does not negotiate. Here is the part nobody talks about at the holiday dinner table. 7 of those 10 best days happened within 2 weeks of the 10 worst days. According to JP Morgan, not months later, not after the dust settled, immediately after, the snapback and the sell-off are practically conjoined. You cannot capture the recovery without being present for the collapse. They are the same event experienced in sequence. The bounce is not a reward for patience. It is a mechanical consequence of the same volatility that caused the drop. Selling during the drop is not just missing the bottom. It is guaranteeing you miss the single best day that follows. Every institution with a financial product to sell has a structural incentive to tell you to stay calm during a downturn. That happens to be correct advice. But it is worth noting that none of them make money when you move to cash. The alignment between their incentive and the math is a coincidence worth naming. The math stands on its own. DALBAR, the research firm that has tracked investor behavior since 1985, published its 2024 numbers in March 2025. The S&P 500 returned 25.02% that year. The average equity fund investor earned 16.54%, according to their quantitative analysis of investor behavior report. The gap, 8.48 percentage points, was the second largest investor performance gap of the past decade. Not caused by fees, not caused by bad fund selection, caused almost entirely by timing, buying late, selling early, reacting to headlines. The behavior gap. Morningstar S 2025 mined the gap study based on data through December 2024. Estimates it costs the average investor about 1.2% per year. Every year, exposed over decades. Those numbers are not a performance drag. They are a second fee, invisible, unitimized, and self-inflicted. You check the number, close the app, opened it again. Same number. Now take the claims adjuster in Indianapolis. Project Forward. They are 29 now. They have 36 years until 65. Let us say they panic sell one more time. Maybe in 2030, maybe in 2033, whenever the next downturn comes. Because one always comes, same pattern, sell low, sit in cash for 2 months, buy back in higher. Each instance costs them between 20 and 40,000 in lost compounding by retirement. 2 panic events, call it a combined 60,000 in direct losses, which becomes north of $300,000 by 65. When you let that gap compound, start with the original $185,000 cost from 2020. Add another 300,000 from one more panic event over the next 3 decades. The portfolio at 65 is not 500,000 less than it should be. It is closer to 485,000 less. Let that sit for a second. Same contribution rate, same income, same fund, same economy. One variable different. The decision to sell during 2 separate weeks of fear over a 36-year investing life, and the total cost rounds to roughly $500,000. The plant metaphor works here too. Every time you pull it out to check, the roots get shorter. 2 pulls over a lifetime, and the tree never reaches full height. Not because the soil was bad, because the hands would not stop reaching. Not because of what the market did. The market recovered every single time. Because of what the investor did during the 14 worst days of a 36-year timeline. 14 days, $485,000. 1% of the calendar drove 100% of the gap. And that is the final number, not an opinion, not a projection. Just compound arithmetic applied to the most common behavioral mistake in retail investing, across the most well-documented asset class on the planet. The data from JP Morgan, DALBAR, Morningstar, and the S&P 500 index itself goes back decades. The pattern has not broken once. The people who stayed in their seat every single time came out ahead of the people who flinched, not by a little, by a house, by a decade of retirement income. You are not bad with money. The math is just built to punish the flinch harder than it rewards the discipline. And nobody told you that part.